Okay, so we have discussed about in our last class about the different types of accounts. So I'll do a brief recap before we go further. Maybe the non-commerce students may not have understood the concept. Okay, so I had started my concept with journal. What is a journal? It is a book where you are recording the details of transaction based on the chronology, means whichever is occurring first, that is written first. And in that we are going to write which account is debited, which account is credited. As any transaction recorded is first entered in this book, we call it as a book of original entry. So it normally has, 5 columns. The first column is date with serial number, then the particulars of the account to be debited and credited. Then there is a ledger folio column and the two debit and credit amount columns. So along with that, we are writing the explanation about from whom the cash is coming or going. So the transaction details in brief summary also is written in the journal accounts. Okay, so we have already discussed about why is it useful. So it is a book where you are getting the details of every penny spent, any errors which you make while putting it into the main accounts, you can locate it in a journal. Okay, so when you're talking about journal, we have 3 types of accounts. I told you before, it is personal account, real account and nominal. So personal account, again they are bifurcated into natural, artificial and representative personal accounts. Real accounts are bifurcated into tangible and intangible assets. Nominal account are bifurcated into expenses and losses, and the other one is income or gains. So natural, personal account, what are these? So personal account are maybe the natural or normal person, say any person's account can be considered as a natural person. So it may be a human being, girl or boy, doesn't matter. So those accounts are considered as personal account. It may be your landlord's account. It may be a person who has purchased. It may be a person who has sold goods to you, or maybe the rent, commission, whatever it is. So any person you are dealing with cash or with goods, those accounts are termed as personal accounts. Then artificial personal account means these are the accounts of institutions, corporate bodies, organizations. They may be banks, clubs, societies, government offices, companies, firms. So any organization, any institution, those are termed under artificial personal accounts. Then the next one is representative personal account. These are accounts of expenses or income which are outstanding or prepaid, or we say you have anything which is not received or yet to be received. Okay, so anything outstanding of last year or anything advanced for next year, all such accounts. So any expense or any nominal account which is having a prefix of outstanding or prepaid or advance, such account is termed as a representative personal account. Now, what is the rule of debit and credit? So, for personal account, you are going to debit the receiver and credit the giver. Say, for example, Arun is paying Seema 10,000 rupees. Now, who is the receiver here? Seema is the receiver. So, Seema's account will be debited and Arun is giving the amount. So, Arun's account will be credited. So, the rule for personal account is debit the receiver, credit the giver. Then real accounts. These are the accounts of assets. Okay, so these may be real assets or tangible assets or intangible. Now, tangible means those assets which we can see, touch, feel, smell. Okay, so anything which is visible with our eyes, which we can feel with our touch, such assets are called as tangible assets. So here it includes machinery, factory, building, furniture, vehicle, cash, gold, investments. Now you may say how you can touch investment. Investment money is invested and you get a contractual document for it. Okay, so that money anyway can be touched. So all these are tangible assets. Then the second part of real accounts are intangible assets. So intangible assets include goodwill, patent, trademarks. So these are assets which work in their own way, but we actually can't store it or touch it. Okay, so these are virtual assets which we cannot touch. It may be goodwill, your brand name, patents, and so on. So these are the real accounts. So the rule for debit and credit here is debit what comes in, credit what goes out. Means you are purchasing an asset. Okay, you purchased a furniture for 20,000 rupees. So what is coming into the business? You are purchasing that asset, means that furniture is coming into the business. And what have you given in return? You are giving cash in return. Okay, so cash is tangible, furniture is tangible. So what is coming in? Furniture is coming in. So furniture account is debited. What is going out? You are giving cash. So cash account is credited. So the journal entry will be furniture account debit 10,000 rupees. Cash account credit because cash is moving out of the business. Then the third type of account is nominal account. So nominal accounts is the accounts of expenses, losses, income or gains made by the company. Okay, so all the expenses, it may be including your salary, wages, rent, stationery, then advertisement expenses, repair, maintenance, postage, any expenses which you make, transportation, all expenses, commission paid, all these are considered as expenses. Then what are losses? Losses means when you sell something and the revenue got is less than the cost incurred. So any such type of a loss. So expenses and losses are always debited. And you gain something, income, maybe commission received, interest received, profit, all these are credited in, and these are nominal accounts. Okay, so the rule for nominal account is all expenses and losses are debited and credit and income and gains are always credited. So these are the different types of accounts. So I told you about which personal account, which nominal account becomes personal account. So I've given you a few examples. So if it is only rent or interest or salary or insurance, these we considered it as nominal account. So if a prefix is there for this, say for example, prefix or suffix, rent prepaid or outstanding rent, interest in advance, outstanding interest. So any such prefix or suffix is there, the nominal accounts change into representative personal accounts. Okay, so with this knowledge, we'll go to how to record in a journal. I told you this is a pro forma journal. Okay, it is having a date column, then the account details and its explanation. The ledger folio means the reference number or the page number where that particular account is there in the ledger book. Then the debit and the credit. Say for example, you have purchased, you have opened a new restaurant and you are giving them home delivery service. So you are purchasing a delivery equipment. Okay, so that delivery equipment is costing 14,000 rupees. Okay, it may be a second hand vehicle also, because in 14,000 rupees you may not get, you may say. So think that maybe second or first hand doesn't matter. I am purchasing a vehicle. So that I am not giving everything 14,000 in cash. What I have done is I have given 8,000 as cash and remaining 6,000 I told him I will pay next month. So it is accounts payable, means it is a small loan which is payable in few days from now. Okay, so what is coming into the business? You are purchasing a vehicle, so delivery equipment or the truck, whatever it is, so that account, it is an asset or a liability or a nominal, which type of account it is when you talk about equipment or vehicle? Yes, anybody? Yes, is it a personal account? Is it a real account or is it a nominal account? When you talk about equipment or vehicle, what kind of an account it is? Yes, can you hear me? Answer yes or no. If you say no, at least I can understand.
Yes, ma'am.
Yeah, so what type of an account is an equipment? Is it a asset? Is it a expense? Or is it a person?
Asset.
Asset, yes. So it is a real account. So what is the general rule? And cash, cash is what? Assets or person, what it is?
Assets.
Asset, okay. Then accounts payable. Accounts payable means you have taken a loan from some person, right? So accounts payable is a person's account. Okay, you are paid. You are going to pay to that owner of that vehicle or maybe that company. Okay, so here we have three accounts. Equipment is purchased. Half amount or say some amount is given in cash. Some amount is taken as a loan. So we have three accounts here. Equipment is an asset. Cash is an asset. Accounts payable is a person. Okay. So, what did I tell you? For assets, the rule is debit what comes in, credit what goes out. So, you are debiting what comes in. What is coming into the business? It is the equipment. So, we are debiting delivery equipment account with 14,000. Then what is going out? Cash is going out. Okay. So, credit cash 8,000 rupees. Then accounts payable, it is 6,000. So accounts payable is a person. What is the rule for personal account? Debit the receiver, credit the giver. Now the person who is selling is giving you the equipment. So he is account. So credit the giver. So accounts payable is credited with 6,000. So total we have 14,000 debit and 14,000 credit. Okay, once more I'll tell you. Asset is coming in. So we are debiting it. Cash is going out, so we are crediting it. Then this person is the giver. He is giving us the equipment, so his account is credited. Okay. So based on this, there is one small illustration. Here there are the list of different transactions taken place in the month of July in 2007. Now we are going to write it in the journal. Okay. So first, this transaction is Mr. Ram Krishna started business with cash. Okay, so a person is starting the business. So the person Ram is giving amount to business. I told you we have a rule that the owner is considered as different from the business. So any amount the owner gives into the business, he is considered as a giver to the business. So how will the entry be? So cash is coming into the business. Ram Krishna is giving cash or investing cash in the business. So cash is coming in the business. So cash account is debited with 2 lakhs. And who is giving it? Ram Krishna is giving it. Ram Krishna is a person. So his account, we call it as capital account because it is Ram Krishna's capital account. So that account is credited with 2 lakhs. Okay, see once more. Ram Krishna started business with cash 2 lakhs. So he is giving it to the business. So cash is coming in the business and Ram Krishna is giving. So cash account debit, capital account credit. Clear? Understood?
Yes, ma'am.
Okay. We'll move to the second transaction. Yes. Okay. Before that. So what I've written here, can you see this? This is I've written on the date column July 1st. Then in the particulars I wrote cash account debit, capital account credit. See here. Then in below that in a bracket I have written something. So this is called as narration. Narration means the small details about it. 2 laksha heng bantu, right? So from where, why this 2 lakh came? So we have to write here. I have written here being business started, being amount invested by Ram Krishna in business. So you have to write why Ram Krishna gave this money. So he is investing in the business. So that details we are always starting it with the word being. Being start of business made by Ram Krishna. This sentence is called as the narration and it is always written after every transaction in the journal. Then second way, goods purchased in cash. Now with the cash invested on the 4th of July, Ramakrishna is purchasing something goods to start his business. The cost of that goods is 2 lakh rupees. Okay. So now here when you are purchasing, goods are coming into the business. So purchase account or goods account debit. Okay. So we are purchasing goods and you are giving cash. So goods account, goods is coming in. So goods account is debited or purchase account is debited and we are giving cash. So cash is going out. So to cash account means cash account is credited. Okay. So purchase account debit, why? Because goods are purchased and they are coming into the business. So debit what comes in, credit what goes out. Cash is going out, goods are coming in. So in the below you are writing being purchase of goods in cash. Third, Ramakrishna deposited some money in the bank. Okay, so from what was there in the business, in the cash counter of the business, he is investing in the bank. Okay, so what is happening? In your bank account is also an asset. Its balance is increasing. Why it is increasing? Because he is depositing in the bank. So bank account asset is going. So bank account is increasing. So we are writing there 40,000 debit and cash is going out. So from my pocket, it is going to the bank. So bank cash is coming into the bank and it is going out of the cash counter. So debit what comes in. So bank account is increasing 40,000. Or bank account, I said normally it is a personal account. So debit the receiver. Who is receiving? Bank is receiving. So 40,000 debit and cash is going out. So 40,000 credit. Okay. So when you are depositing bank amount in the bank, bank is receiving money. Bank is considered to be a personal account. So debit the receiver and cashing is going out. So credit cash 40,000. So you write there being deposit made into the bank. Then next on July 7th, there is goods sold. So they have not told about whether it is sold to a person on credit or anything. So if nothing is specified, we consider it as goods are sold for cash. Okay. When they are giving it to somebody on credit, credit and right? You are giving udhari, right? So when you are giving udhari, you write it specifically to Kalmesh on credit, but here nothing is written. They are just saying goods sold. So we consider this as cash. So how you will write? So when you are selling, what happens? Goods are going out and cash is coming in. So cash account debit and sales, goods are going out. So to sales account. So cash account, as cash is coming in because of sales, cash account debit, sales account credit. You write here being sale of good in cash. Then the next one, on July 10th, goods were purchased from Mr. Kalmesh on credit. Okay, now here one person is involved. Now goods are being given to Mr. Kalmesh and he has not paid cash. He will pay later. So what happens here? You are purchasing goods. So when you are purchasing goods means goods are coming into the business. So purchase account debit and who has given it? Credit the giver. The giver is Kalmesh. So Kalmesh has given, it is a personal account. He is giving you goods. So his account is credited with 25,000 and goods are coming into the business. So anything coming in is debited. So every account, every transaction has one debit, one credit, and it is always equal credit and equal debit. So we write being purchased on credit from Mr. Kalmesh. Okay. Next, furniture purchased on July 11th, that is 18,000. So when you are purchasing furniture, they have not given anybody's name. So we consider it as cash. So what happens is furniture is coming in, it is a real account, asset account. So both these are assets. Furniture is an asset, cash is an asset. So furniture is coming in, debit furniture account with 18,000. Cash is going out because you are paying for that furniture. So credit cash with 18,000. And we write here being purchase of furniture made. Then the next thing, on July 12th, he paid wages. Maybe there are some laborers in his company. So for them, he is paying wages 8,000 rupees. So when you are paying wages, so wages is what? Wages is an expense and you are paying cash to them. Okay, so cash is an asset, wage is an expense. What did I tell you? Expenses account is debited. So wage account debit. What is going out is cash, so cash account credit. Being payment of wages made. Wage is nominal account. So as it is an expense, we are debiting it, and cash is going out, so we are crediting it. Next, on 20th July is interest received 500 rupees. Now, when you say interest received, anything received means it is income. So anything income is always credited, and you are receiving what? Cash. So cash is coming into the business. So cash account is debit 500 rupees and you are receiving income. Income is always credited. So cash account 500 debit, interest received account 500 credit. So being receipt of interest is the narration. Then last but one, cash paid to Kalmesh. Remember here we had purchased some goods from Kalmesh on 10th July. Now we are paying it on 25th, that is 25,000. Okay, so we are paying cash to Kalmesh. Now Kalmesh is receiving cash. It is a personal account. So Kalmesh account is debited with 25,000 and cash is going out of the business. So credit what goes out, debit the receiver, credit what goes out. It is 25,000 debit and credit. So being payment made for credit purchases. So why we are paying Kalmesh? Because on 10th July we had purchased something. So today we are making the payment. So payment is made. So cash is going out, 25,000 credit. Kalmesh is receiving the amount. So his account is debited. Then the last transaction. Ramakrishna invested additional capital in the business on 30th July. So again, cash is invested in the business. So cash is coming in the business, debit 50,000. And who is giving? Ramakrishna is giving. So credit the giver. The giver, Ramakrishna, is the owner. So we write it as capital account. So cash is coming in debit and the person is giving it. So his account is credited. So we write the narration being introduction of capital, additional capital in business. Okay, so this is how we write journal entries.